Hi, everybody. Good morning from Rye, New York. Since COVID started, it's been Rye, New York, and not the World Trade Center. I guess it's now so much known with our sessions that I will always have to keep on doing them from Rye, New York. I will start by reading a little bit about our distinguished speakers today. First of all, good morning, Kevin and Judy. I believe you're in Toronto.
Good morning, Danny. That's correct.
Yes, great. So let me just start, while people are getting on the call, a little bit of, let's get familiar a little bit with our speakers. Kevin McCreadie is a Chief Executive Officer and Chief Investment Officer of AGF Management Limited. In the role of CEO, Kevin is responsible for the overall success of AGF, overseeing the firm's mission, vision, and strategic direction. He also leads AGF's executive management team and serves as a liaison with AGF's board of directors. As CIO, he provides direction and leadership to the investment management teams and leads the firm's global institutional business. In carrying out these responsibilities, he leverages the office of the CIO, a structure put in place in August 2018 that encourages collaboration and active accountability across. Kevin brings 35 years of investment management experience to AGF with extensive expertise in retail and institutional asset management, direct portfolio management, and over a decade of combined experience as a CIO for two major US financial service firms, PNC Capital Advisors, one of the largest diversified financial service organizations in the US. In this role, he was responsible of leading the firm's institutional business and overseeing more than $58 billion in assets under management. Kevin began his career in '82 at JP Morgan, and I will go now and tell you a little bit about Judy, a renowned leader in the asset management industry and one of Canada's most influential businesswomen, which I really hope to have at our next Toronto-based conference, Judy. As president and head of global distribution of AGF Management Limited, she oversees the execution of strategic plans in support of business priorities, counsels the CEO on business planning and provides direction for corporate initiatives. She's a member of the executive management team where she assists in the development and execution of AGF's strategy. In addition, as a member of the board of directors and AGF mutual funds as well, she provides strategic leadership and vision that promotes the long-term growth. Since joining in '98, she had several roles with increasing responsibility. Prior to being named president, she served as executive vice president and chief operating officer. She received a Bachelor in Arts in Economics from the University of Toronto and earned her Bachelor in Law from Queen's University. She's a member of the Law Society of Upper Canada and has been a member of the Canadian Bar Association since 1993. In 2019, she received an honorary doctorate of laws from the University of Toronto. In 2015, she was named a top 100 Hall of Fame inductee by the Women's Executive Network. This distinctive honor given to women who are nominated as one of Canada's most powerful women, top 100 for a fourth time. And before that was recognized by the WXN in 2012, 13, and 14. She was honored as one of the Women's Post top 20 women of 2010. I think that's amazing, and I think we should definitely do an entire session about women, business women leaders in Canada at our conference. So I made a note about that. And I believe there's also a family business side to it all as well. I'll give you a chance to talk about that. So maybe in your own words, just before we jump to our to what we are going to discuss. First of all, how are things in Toronto, COVID-wise? How are things going on?
Well, I'll start and I'll let Kevin, who unfortunately has the
Well, he's originally from Baltimore. I'll let him speak to his own situation, but in Toronto, we're still in lockdown. And so we actually have no restaurants opened. It's just takeout food, and schools are back. That's the one positive. But generally speaking, it's been a long, long lockdown period since about middle of December.
Got it.
Yeah, no, I would just add to that, Denny. In Toronto, the winter can be a little bit tough too. So we've been actually, if we really go backwards for many of the folks in North America, we've been locked down from outdoor dining since October, haircuts and indoor dinings from November, no retail. So and now under an emergency order, plus in the dead of winter. So hopefully we're thawing, and we get another month or so of this, and then we can start to move toward a world that looks like the rest of, with vaccinations and stuff like that, starting to bring things to reopening.
And I just managed to make myself actually visible. By playing with all those. So maybe I'll start with Judy. Our audience might not know the history of the firm and its legacy for innovation. Maybe you can tell us a little bit about the firm and the family connection I was talking about earlier. We've been here for only 5 minutes. Yeah.
Sure. Thank you. Well, obviously, I'm very, very proud of the family connection. My father started AGF in 1957. He started it with a very simple concept, which was to allow Canadian investors access to the U.S. marketplace through a pooled vehicle. And that AGF is our mutual fund namesake, which is the American Growth Fund. And we started back in 1957 with that one fund, and now have approximately 37 billion of assets under management across a suite of mutual funds, ETFs, alternatives, and liquid alternatives, as well as a quantitative business. When we look at innovation, it's been critical to the long-term success of AGF. Mutual fund companies traditionally, through Canada anyway, in Canada, went through a large degree of diversification and amalgamation as well through the late 80s, early 90s. And what we found was that what we ended up doing was bringing on new and innovative different strategies to try to make sure that we could evolve our business. So we view ourselves as a global asset manager across all streams of distribution, whether it be institutional, retail, and private client as well. So we're really excited about where we stand today. And AGF, as I said, has really found its place in the market.
And it's interesting, I believe that, your background is law.
That's correct, yeah.
So why not join after law school? What really stopped you from doing that?
Well, my father was a big believer that any member of the family who thought they could join the family company, which we have 650 employees now, so it's not quite quote unquote family, it's a large company. He expected us to all earn our own stripes, find our own way, and really be proven in your own job first and foremost. I consciously did take law to be a distinguishing factor. My brother is the honorary chairman of, executive chairman of AGF. He had been involved with the company since 1987. I joined in 1998 after practicing law for about 6 or 7 years. And it really was a way for me to establish my own degree of capabilities and confidence, and frankly, be more credible when I did join the family company in 1998.
Coming from the family space, and I've, interviewed loads of families throughout the years. One of the major families I spoke with several months ago was McLean, which were a huge family from Texas, Walmart. And not only did the next generation had to work and prove himself in other areas, they started from the bottom up, really. They actually, I think he told me, Drayton McLean, that he had to really work midnight hours, work the midnight oil and graveyard shifts, loading vegetables to the trucks before he could do anything. So it's interesting that you also had to prove yourself in other areas. And what made you join the firm? Weren't you worried, you'll be looked at, always under his shadow, or suddenly a different field? You studied law, you were doing pretty well with that, given the awards and your membership. What brought you to actually leave that and actually join the family business?
Well, I had worked at AGF through the summer. It was a great way to, when I was a younger kid, a teenager. In fact, my first job was in the mailroom, and I still remember the good old days when you would have to fold letters and actually stuff envelopes. It wasn't automated. And that was my first job at AGF. And then I worked in the accounts payable. I actually worked on the trading desk. And so I had an opportunity over several summers to get to know the business. And it was something that I was very proud of. And I was very passionate about the business. And I'd seen my dad obviously enjoy working. And he was just very proud owner of a company. And he was very clear to me that if you do join the company, he said, just expect that you're going to lose a lot of sleep, and you're going to always be worried about the business, and you're always, going to have to be looking at other people and looking after your employees and the business. But it's an incredibly rewarding experience. And so in 1998, we had grown to a size where they did not have in-house legal counsel, but we had grown to a size where they had then turned to look for in-house counsel to be hired. And I was approached at that time to join, and the rest is history, as they say.
And what advice would you give the second generation of family businesses?
Well, you're right about being under the shadow. I had the added compliment, I guess, of working with my brother, who was very much in the business at that time. When I joined in 98, he had assumed the president's role in 1996 and then moved into the CEO role in 2000. And so I really thought I was perhaps going to join to work with my dad, but in fact, I was working much more closely with my brother, which in retrospect was a fantastic way to ensure that the second generation really did get their hands in the business and on the business, and were looked together as credible members of the community, if you will, so that we were taking the business seriously, we were solidly in the next generation, and that the business would continue. And so I think my advice simply is you do have to work really hard. You have to prove yourself, and do not take anything for granted just because you have a common last name, as it worked out in our business.
I think on the contrary, I think there's more to prove in your next generation. Prove others that you actually can do it yourself, and and get things going. So that's very interesting. And Kevin, you joined AGF in 2014 as president and CIO, and now the first non-family member in the role of CEO and CIO. So what was that like? Yeah,
no, thanks, Danny. And I would just echo something Judy just said. I've always thought about the fact that being the coach's daughter or the coach's son is always the toughest spot on the team, right? So, having the founder's last name is always a challenge in a different way. The bar is always set higher, and Judy and Blake have always achieved to that level. For me, I've been a CIO since 2002. I was very young at the time, and I had just come out of the first crisis, the tech crisis, and I went through the 2008 crisis, and I was at a point in my career where I had children that were in late elementary school, about to end to high school, and I wanted to look at one more opportunity for basically the rest of my career. So I spent a lot of time. I could have stayed happily where I was, but Judy and Blake had been doing a search for a new CIO, and so we spent about I'd say 6 months talking about where the firm had come from and what it wanted to be. Recognizing that the world was changing a bit. This was post 2008. We were midway through, right, to where we are today. Thinking about asset allocation, that would be different. Thinking about vehicles, that would be different. And so we spent a lot of time talking about it, and to make sure there was alignment. And then about 2 years ago now, a little more than 2 years ago, I stepped into the CEO chair, which we had talked about in the beginning, when I came on board. And we went through an interesting process. Blake and I had become close to someone who was on our board. He was a very, very prominent family-owned business in Canada that had gone public, where he had transitioned to a non-family member, a very successful business. And he had sort of mentored both of us on how to think about the future. As Blake would step into a different role and I would step into his. And I will tell you, being the first non-family member after 60 plus year history is a hard spot too. Equally as hard as it being the son and daughter of the coach, it's also hard being the other kid in some ways, in a good way though. But we spent a lot of time constructively, Blake and I, and with this third party, talking about what our roles would be, what would success look like, how we would interact. And I would tell you, 2+ years in, because of those clear lines that we laid out and how we interact and how we communicate, it's been pretty seamless. And I think a lot of it has to do with getting that understanding up front of all the parties, right?
You mentioned two things here, being under the shadow of the first generation, which is definitely, an issue. I'll tell you, my father is one of Israel's most famous guitar players. And when we were growing up, me and my brother, we always said, you know what, we want to be good enough in what we do that they're not going to say, oh, here is Yigal's kid, but on the contrary, here is Danny's father. We never accomplished that, and we ran away from music industry because of that, and we went our own way. But and another thing, you mentioned family business and being a traded company. I can tell you that there's a research, well, there were many research that were done, but one that was just done in Israel by a next generation that's a very good friend of ours, the Strauss family, about traded family businesses versus traded non-family businesses. And when compared to the same sector, it showed a huge difference in the in how well the company did and the valuation of the company when it was a family business and when it, compared to those who weren't, because there is so much connection to it, so much emotional connection to it, so much work that's being put. I mean, it's no longer, when I that family is Strauss, one of Israel's largest families. It's no longer. Of course, it's the capital that comes with it, but these people already have so much. That's not what really drives them. But the connection to the legacy of the family and trying so hard to get to places where similar companies may have a little bit less of. Anyway, back to our discussion. So back to Judy. So AGF is a publicly traded company, but through the voting structure, the family still has a notable influence on the future of the company, which I guess has some connection to what I just mentioned as well. How did the family make the decision to transition the reins to someone outside the Goldrings?
I think it's first of all, we were very conscious about wanting to retain momentum in the industry. It's a mature industry if you look at the pure mutual fund side of our business. And in order for us to really leap to the next level, we wanted to bring in a top quality investment manager and an investor, someone who could see us take the company to the next level and expand our scope and what we were focused on. So as I mentioned, we grew up as a mutual fund company. Under Blake's leadership, we did become more globally focused and got into private client businesses and then started down a path of alternatives. And really, to get to the next level of alternatives, we needed a very capable individual, and we were lucky enough to find Kevin. And don't ask him to tell you the stories about how I wooed him up to our company and all the fun discussions you have as you go through that exercise to find an American who was willing to move and transplant his family up to Canada. It was a difficult search, but we're really fortunate to do that. And I think transitioning under his leadership has just provided a different approach for the company. It's given us a different perspective, and it's given the street a different look at AGF as well. And that's been very important for our continued success.
And why was it so important? And why now?
Well, I think it's important because, Blake and I are committed long-term investors in the business and in the industry, and we want to see this business carry on. And, Blake could have arguably stayed, he's not much older than Kevin. He could have arguably stayed in the role of CEO for many, many years. I think it was a combination of opportunity, not wanting to lose Kevin and his acumen and his talent, and making sure that we were positioning ourselves for the future, because this industry and this business is really critical. It's a great business to be in. We have got some gap between any new Goldrings to the younger side of the family, like Blake's daughter has joined the company. So we're looking for that, but she's early 30s. There's a long road ahead of us, and I think there's lots of things that we can do, and bringing in new thought leadership was really critical for our long-term positioning and success within the business.
Kevin, where are you from originally? Where were you in the U.S.?
Yeah, so I'm an American, but now I'm a permanent resident of Canada. Proudly, my whole family are now permanent residents. But I was born in Chicago, and then spent most of my time on the Northeast, and most recently was in Baltimore, which is, it was sort of a nice place that was 2 hours from New York and 1 hour from Philly, and 40 minutes in Washington. You get pretty much anywhere on the East Coast pretty quick there.
I think the most important thing for an American that comes first time to Toronto is to understand that everything happens underground, because the first time I came, I didn't know that. It took me 9 hours to find a Starbucks when everything was just beneath me. Anyway, in the role of a CEO, Kevin, what's your vision for AGF? How will you maintain the firm's history and innovation?
Yeah, so one of the important things for me is I wear two hats, and I interchange this hat multiple times a day. I wear the CIO's hat a lot of the day, and during crises, I wear it a lot more during the day than in just when times are just kind of normal. And I wear the CEO hat as well, but the CEO hat, I'm enabled by the fact that I think an incredibly strong team around me, with Judy sitting at the center as president. But we basically, if you think about our firm in that 6 years, Judy, we have rebuilt the entire management structure around the new strategy and vision. And so it was a combination of promoting people who were here, who had talent, into further in developing their careers, and bringing people in that had skill sets that we didn't think we had for the future we wanted. So for instance, we were going down the ETF path. We were a fund company. We said, who has done that already? And we reached out into BlackRock and picked off their head marketing person. So a combination of people promoted from within and brought from outside has allowed us to develop the strategy for the future with a strong and bonded leadership team that shares that vision. So that was probably point one, because a lot of the day I do have to wear the CIO hat, and so I need the CEO hat has to be assisted by that group. And it's something we touched on in the beginning, but during this crisis, we went into this and we pulled together that team that met twice a day, every day on the weekends, until we made sure we had ourselves buttoned up and through it. And I proudly look at that and say, many firms struggled, we didn't, and I think we didn't because we pulled together and had a common sense and purpose. For me, when I joined here, and I alluded to this a few minutes ago, it was really around where we were going to go. And the firm always interested me when I looked at it, because for its size, it was this wonderful global boutique. It had been distributing products globally around the world for years. It had been innovative in the newest of first-time generations and things within Canada. And so it was an opportunity to say, all right, this is a firm that has been used to changing. Will they be able to change for the future again? And so we, for me, looking at things like, we had the longest tenured ESG manager within the shop when I arrived. And we looked at ESG and we said, we think it is going to be important. We're a signatory to the UN PRI. But now how do we think about that differently for the future? So we were probably earlier than most on this, to think about more thematic things. Think about wrapping PRI innovatively through all our investment processes, right? And then, but I'd say as we look forward, we look at investor portfolios and say, I don't know that our industry will ever create great new fundamental managers. I think the ability to harness data, process data, use data to feed fundamental teams, to make their research easier, quicker, is going to be more relevant. So we have invested quietly in the last few years into probably one of the largest quantitative capabilities within Canada, probably approaching 25 people-ish today. That is now a backbone for our future. It feeds our asset allocation decisions, it feeds all of our management teams, and it runs discrete products for clients, large family offices and others who want to do bespoke portfolio management and solutions. I'd say that probably the biggest vision for the firm is pivoting and continuing to diversify along what we think are what investors are going to need for the future. So the biggest shift was really in 2014 to decide to go into the alternatives business. Blake, Judy, and the management team that was there before I got here had come to that conclusion. I had reached that conclusion independently as I was thinking about where the world was heading. And so we have moved from a firm that had nothing in alternatives a few years ago to 4 funds later, closing in on $3 billion of assets in the alternative space. And we think about the end investor and how they're going to have to get experiences differently, different correlations to different asset classes. How do we think about risk management? So we've spent a lot of time not just on the quant side, but also on the risk management side. It increasingly becomes important. So the vision for the future is about asset allocation solutions for clients, but in a way that is repeatable, disciplined, and wrapped in large risk management. So as we evolve, if we sit here 10 years from now, our fund business will be important to us. My guess is our alternative business will be one of the bigger pieces of our business. And, we'll continue to innovate, whether it be in liquid alternatives, private alternatives, but really across that spectrum.
Now, thank you. I have now I'm getting to a very interesting question. I'm going to make it long because it is important. The markets. The pandemic resulted in a swift crash and then record fast recovery of the stock market. And as the markets race higher, this has been in stark contrast to the economy that's been growing very slowly. What do you see happening in 2021? How does that shape up? And I want to say something. I used to be a financial journalist, and I remember when Mary Meeker and others told us that the internet, some internet companies are going great. There was a big bubble, all came crashing down. And the reason I mentioned that, I spoke, when this started, I spoke with our friends at Stikeman, and they sent us a report. I think it was one of the big guys, JP Morgan, Merrill Lynch, and I'm reading the report, and they're saying, oh, everything's fine. The stock exchange, that's where you need to go. It's all, all priced in. And I remember, I don't need to explain what happened in the real estate crisis in the United States. And I did a post and I wrote, you know what, I hear you guys, but I think that it's just crazy that what we're seeing now, which is probably the worst we've ever seen in our lifetime, hasn't really even ended. I mean, we're not even at the point where, okay, it ended. Now let's count our dead. You're not even there yet. And the snowball we're seeing here, the chain reaction that's going to come, I don't want to even start. I mean, how is that priced in the market is something beyond me. And I wrote a post about it on LinkedIn, and most agreed with me. One said, you know what, I don't argue with the big guys that know the numbers. And I reminded them that the same big guys who know the numbers were the Mary Meekers and those that sold us the real estate. All I'm saying is I don't understand how the market reacted so well to something. It doesn't even understand the magnitude of it all. So coming back to my question, what do you think we've seen in the market? Do you think this is real? And back to my question, how is 2021 shaping up?
Yeah, I mean, I'm going to bring you back to 2008 to start, right? Because 2008, we had a financial crisis that almost took apart the banking system. Society can't function without a worldwide banking system that the plumbing works. What we had here was akin to a natural disaster. We basically told societies, you're going to go home, you're going to hibernate, we're going to get you through it. You got to trust us that we're going to make sure that we're going to transfer payments to you, but stay home. Usually in a recession, we ask you to go out and spend. We cut rates, try to incent you to take risk so you can go out and buy a car or a house. Here we said, go home, don't spend, try to be safe. So you have to think about it like a hurricane of major proportion, or an earthquake where you devastate capacity to do things for about a while. I'd say the market moved dramatically because we had all the plumbing in place to put in from the central bank's standpoint to keep markets liquid. Very different than 08 where we had to build all that stuff. And then two, the fact that central banks worked with governments to create fiscal stimulus. How do we get transfer payments, extended unemployment benefits, stimulus checks to keep people afloat? And societies throughout the developed world have pretty much been able to do that. Yes, we have record unemployment still, but we've gotten through it. There are three phases that I'd touch on. One is that first phase was the banks and governments are there for us, and that was the first part of the recovery. The second was the reopening in June, right, when people first heard of possible vaccines on the horizon, and that life would come back to normal. I'd say the real marker is September of last year, when you saw phase 2 data on the vaccines. It said, not only are they possible, they're real, and we're going to get real data on getting them into people's arms within 6 months. And that happened in November. And you saw that's really been the powerful three phases of this market. And now you're right, Danny, we're here. And always the markets aren't the economy. They are very different things. If you take the S&P 500, it's, between its technology and healthcare weight, it actually does not look like the U.S. economy, right? It's not, we don't 50% in those sectors when we think about it, right? So the economy is different than the market. It always will be. The market will move ahead of it, and then it will look over its shoulder and wait for the economy to catch up. And that's where we are right now. If you go back to the crisis of 08, remember the bottom in March of 09, the market from that point to the end of the year was up 67% on the hope that all this stimulus, the repair of the banking system, TARP, all that stuff was going to help heal. We got to 2010 and we looked over our shoulder and the economy was still dragging. And we had a series of mini corrections throughout 10. You ended the year higher, and I think that's the parallel we're looking at here. And I'd say one other thing here. We're not out of the woods, to your point, but we've become immune to the death toll, sadly, right? It no longer is a thing that people focus on every morning. Then they don't even focus on cases. We're now focusing on vaccinations, right? And if you look at the bond market, it's telling you that the world is going to be fully vaccinated pretty quickly because it's backed up and says all of this is going to massively amount to big stimulus, big growth in the future. I think that we are going to end up higher from here, but it's going to be a very different path this year. You're going to see days of fits and starts. You're going to see pressure on interest rates that could pressure stocks. And you are going to still have to repair these economies. And at the same time, we're not out of the woods. You're going to need more stimulus in the US. You're going to need more stimulus in Canada. You're going to need more stimulus in Europe. And so I'd say now you got to wait for the economy to catch up to you. So, you're going to be in a series of mini corrections in here. And I'd say the other thing is look at the equal weighted indexes, not the cap weighted, because that is more representative. And so as the market has broadened out in September, which is a good sign, the average stock is starting to do better than those big cap weighted names that had held us together.
Thank you. Now let's move to a growing space, private credit, which is really the topic of our conversation. Investors are taking on more private credit, both as a replacement for equity, as well as a tool to enhance their fixed income allocations. The equity-like return that private credit can yield, accompanied by way lower volatility than equities, has major appeal. But do all private credit react the same in all markets?
Yeah, I mean, I think we got to set the backdrop, maybe, Danny, as well on private credit. We're starting at a place where the front end of yield curves around the world are going to be at zero. And that doesn't mean that longer rates won't move up. As you've seen, the US 10-year has doubled in 3 months. And those are leaving massive losses on somebody who's bought those bonds. Right, and you can look at the number of bonds that are negative yielding in Europe that are now positive. Right, there's some pain that's going to be had there, but when you're at zero around the world, right, there's a search for yield, right, that's out there. So the demand side of private credit, I think, is real, as people do need to find income differently, and at the same time, when we look at the supply of credit, the traditional suppliers of credit are not what they used to be. If you go back to 2009, probably, I don't know, 60% of the credit in the world was given out by banks. If you look at it today, post-Dodd-Frank, the liquidity and capital standards that banks have to maintain to make a loan, they're moving away from the traditional lending functions as a source of growth into more fee-based things. So lending to them, unless there are other things tied to it, becomes less profitable. So others have filled the gap, and the private credit side is a logical player in that. You look at investment grade bonds today, they're yielding 80 basis points above a risk-free rate. You look at high yield bonds yielding maybe 300 basis points. I would argue in the private credit space, the ability to customize terms, create bespoke underwriting, and the ability to get you higher potential returns with lower defaults makes it a more attractive proposition for investors than the public markets or the bank debt market in itself.
Thank you. Judy, what has client demand looked like for private credit?
Well, I mean, picking up on many of the points that Kevin just explained, the demand that we're seeing and we're hearing about really is continuing to increase, and it's accelerating. As Kevin pointed out, there's a search for yield, the suppliers of credit have changed, and the attraction of private credit in a position to be able to deliver higher returns in an environment where you're not otherwise going to get it really has picked up the interest of retail investors as well as high net worth and institutions across the board. So we're seeing it across all of our distribution channels in terms of an increasing demand.
Now, let's talk about the risk areas. Obviously, private credit has its issues as well, its risks. And let's start with scale. There are multi-billion-dollar asset managers in this space. Is that the best opportunity for investors? Does scale matter?
Yeah, let me answer that one, Danny. I think there's a couple of things at play here. The larger you get at something, the ability to do, the bigger the size transaction you have to do. I'm not sure big is better here. For instance, we like the middle market. We think it's probably an underserved market. The return sets are better. That a large scale player who has raised billions and billions of dollars isn't going to be interested in. He's going to be, or she's going to be, competing in very syndicated, probably secured transactions, lower returns. So I think there are different risks from where you sit in the market that you want to invest in. I do think scale is important in the investment function. You need deep credit research. You need very good underwriting skills. You need great back office. You need great compliance today. And so that's the scale I think about. I don't think you have to be a mega firm. I think that the real return sets are going to accrue to the firms that are more boutique-like, that can do the time to underwrite middle market deals, smaller deals, but with a deep credit team and underwriting team and back office capability. So that's the scale I think about, not so much the mega firms.
Leverage, another point, can turn a loan with 8% coupon into a 14% yielding asset, and subscription lines to bridge capital calls have been around for years. So are there any notable challenges with leverage that an investor assesses for themselves?
Yeah, I think leverage is important to drive returns. You need to understand your source that you're going to use for your leverage. If you're using back leverage, make sure that you have a fixed term that matches your asset that can't be called. The folks the bridging lines have been around for years, and people have gotten into trouble when what they thought was their leverage lender pulled that credit, and then you were forced into a sale of your asset that you didn't want. We saw that right now, and I'm going to take the other side of that. We know coming out of 2008 and 2009, some of the best returns for credit investors were in those next years afterwards. I would say, to your earlier point about COVID, we're sitting here with massive amount of dislocation across economies. There's still, I think, going to be some very good opportunities for folks. Again, to your point though, can you use leverage in an appropriate way? Can you fix the term of that leverage to make sure that it's not pulled from underneath you? So I think, hey, you have to think about it a little differently, but I do think that the ability to do private credit right now and use leverage, but also create very specific terms, get equity-like kickers such as warrants and other things in the structure, can help you get to the higher end of that return set. But I do think your point's right. You need a little leverage, but understand where you're getting it from.
And thank you, Judy. When I'm looking at the social impact side of things, a growing consideration across all asset classes is ESG. Can ESG considerations be incorporated into a private credit offering?
Well, thanks for that question, because ESG certainly is another area, just generally speaking, that has grown monumentally over the last year. In 2020, I think people's attention was heightened so dramatically through the pandemic on ESG issues. And certainly when it comes to all investment styles, people are looking for ESG opportunities. There is ESG demand, as I mentioned, across all different types of investment strategies. And so when you come to private credit, one interesting element about that is that the individual projects or initiatives that are being financed, you have a clear picture into exactly how the proceeds of your investment will be used. And so there is line of sight into ESG initiatives in that regard. And then what we're seeing is a high demand of private credit opportunities where you're making investments in renewable energy, sustainable projects. And so depending upon the mandate of a private credit offering, you certainly can see ESG considerations being involved within the mandate strategies. As I mentioned, it's just a continued growth in the demand from the investors and the response by the portfolio manager in that regard.
So the families with us today are mostly, not just, but mostly Canadian, but can easily access private credit offerings around the world. Why consider Canada?
Yeah, maybe I'll take that, Danny. I think that there's going to be a very underserved market here. If you look at the Canadian banks, they've reported, a couple of big ones start reporting today, and you've seen loan demand is not loan demand, but loans are down. So, if you contract just a few percent, let's assume you take 4% off of their loan books because they're moving into other more profitable areas. They don't have to have their capital tied up, capital charges under Dodd-Frank if you're doing business in the US, which they all are. 4% translates into an $18 billion shortfall for people who need credit. So I think the opportunity to get higher returns, because there's going to be a marketplace there that needs to be served, is one. I'd say two, in Canada is one of the more friendly jurisdictions for creditor rights, along with the US. So again, I think you line up the fact that, we have pretty good rules of law around it for a creditor, as well as its demand function. I think Canada would probably ripe as an opportunity, and it's less served, if you will, from the investment management capability to bring it to you. So you put that all together, I think it's a pretty good opportunity.
We're getting some questions, but we'll address them shortly. In light of all of that, to summarize private credit, why private credit? Why now, Kevin?
As I said earlier, Danny, we're going to be at the zero bound for rates for quite some time. At least 2 years if you listen to the Fed. That doesn't mean that the bond market isn't going to do the Fed's work for it. And you've seen, as I've said, 10-year yields have gone in 3 months from mid 70s toward the end of the fall to shy of 140 yesterday. So a traditional investor looking to invest in fixed income is going to be challenged to fight off that creep up in yields from sovereign bonds. There's not much more that can be squeezed out of investment grade or high yields. And so they're going to need to look at how to create income for those families differently. And opportunistically, as I said, coming out of a crisis, the return sets are generally going to be much higher than they would be in more normal times. So we think that opportunity is here. It's now. We think that there's going to be plenty of investments in the pipeline that can be funded fairly quickly here and with pretty decent returns. So it's a combination of where you're going to get it otherwise. I think it's going to be hard to justify, trying to get it out of a straight core plus fixed income portfolio here. I'd say that, I've heard of folks moving into the esoteric parts of the emerging markets area. Even emerging market debt today has had a pretty good contraction in spreads. Those returns are probably behind us. We still like EM, but public debt, I would not play EM private credit. The creditor issues in terms of governments around the world, very different than what we have from creditor protections in Canada and the US.
Now, back to you, Judy. AGF always partnered, had a legacy of partnership. And now I'm looking right now at a press release here where you are collaborating with SAF Group, one of Canada's leading alternative capital providers. So you are partnering with them for your own private credit offerings. Why them?
Well, thanks for that question. We will be launching an AGF private credit LP in short order. And the SAF Group, really, it is a private credit investment firm. It has a good, long, strong track record. It is a group that we have worked with in the past. We had originally partnered our first transaction with them, or we invested in their first fund in 2014, had a very positive experience both financially and working with them. It's led by a gentleman named Ryan Dunfield. And so, we then subsequently have done a second transaction or fund with them in 2018, 19. And again, very positive and successful results. And what we wanted to do at this point was really leverage their credit expertise, but leverage AGF's operational scale and our distribution capabilities. And the combination of the two really make for an attractive offering that we believe will be very compelling to investors.
Kevin, give us a sense of the offering AGF is bringing to the market.
Yeah, so it's a credit opportunity space that gives you the ability to have base returns some opportunistic returns, as we've talked about, potential to use leverage maybe 1x in the fund. But I think the more attractive piece is be able to structure and underwrite, give yourself some equity participation in that underwriting, but also that gives you the downside protection you need. In other words, as you do this bespoke underwriting, can you make sure that you understand the residual collateral that you're going to get? And can you create a stream of equity returns that gives you some support if you do have some issues? And issues aren't bad in the credit space. More importantly, I think for this one, this is an evergreen structure. So the initial lockup's only 2 years on this fund, unlike many of the credit funds that are out there. They're 4 and 5 year period fixed end funds. So I think being an evergreen fund at this juncture, with this team, we've known and worked with the SAF team on three funds. This will be our third fund, I should say. But these are folks that have 25 people. They understand the underwriting process. They've been in the marketplace doing transactions since 2014 and probably have underwritten something like $2 billion worth of credit over that time, 30-odd transactions. Very great return history. So again, a combination of I think the environment is ripe for this product right now in terms of the demand that we think investors have. But I also think the structure is innovative and interesting.
So just one more question before I go to the questions I see lining up here. Judy, we've just touched on the tip of the iceberg. Investors have a lot of choice, and final advice for our audience from you. We cannot hear you.
Pardon me.
Yeah.
Pardon me. I tried so hard. We have obviously just touched just the high level elements of the offering that we're bringing to market. Certainly, I would encourage anybody who may be interested in more information about this particular offering to join us on March 3rd as we have an investor day where you can hear directly from Ryan Dunfield, who will talk much more specifically about the deep details about the product. And we would certainly encourage and love to have anyone join us on that particular investor day. March 3rd at 10, I will get you the time, just a moment.
Great. So while you're getting the time, I can start addressing the
11 a.m. Yes, 11 a.m. Eastern Standard Time, since I know you deal with people all over the world.
Yeah, great. How long is it going to be?
It'll be about an hour.
About an hour. Yeah. Great. So you'll just make it in time for our blockchain conference. It starts at noon. So let's start. Within private credit, have you looked at SBIC funds in the US?
Yeah, we have not. This fund at this juncture is going to be primarily North American focused, but with an emphasis on Canada. We've not looked at the SBIC market specifically.
Do you think inflation is going to come back? Which asset classes, AGF funds, do you think are going to perform well over the next couple of years?
I do think inflation is going to come back. I think what you're going to see is transient inflation around the world as central banks let inflation run hot. One of the concerns you're going to have to fend off is by letting it run hot, and that means adding more fiscal stimulus when you think it may be enough already. Don't confuse asset bubbles with economic overheating. We've tried to engineer inflation for a decade and failed. I think this time we may be successful. Given the combination of significant pent-up savings that are sitting in bank deposits as people have been locked in and can't spend. When they come out of lockdown, you are going to see what I call sin spending. People will be out there buying anything. And so you'll see pockets of inflation that emerge pretty quickly. And then the question is, after 2, 3, 4 months, does that start to abate as that shortage? We know there are shortages of chips right now and other things because of the issues we had. So I'd say, yes, there will be inflation. And whether the central banks can engineer a core inflation rate north of 2% on a sustained basis for a year will be the longer term question. But I do believe there will be.
And with your experience in finance, I want to ask a question. When you look at real estate and you see what's going on in the world, I just spoke to Michael Blumberg, who's a very known in the VC world. He moved to Miami, and I told him, you moved to God's waiting room from the sophisticated cities of the world. I mean, we think in New York we're so smart and sophisticated, and I hope we don't have people from Miami here. And Miami, is not that really. And yet he told me, listen, we are tired of the fires, I'm tired of the taxes, I'm tired of paying so much for my house. And he's not a guy that that has a liquidity issues. I'm getting better, we can work remotely. I'm getting better, sunshine. Why not? Do you see people, do you think that the main cities are going down, like New York and other cities, and that's going to be permanent? And also when you look at real estate in general, which is a different sector, but just, it influences everybody. When you see where I am in Rye, where prices are going skyrocketing because everybody and his mother are running away from New York, and it happens in other major cities, do you see that keeps on going? And then, or do you think, I heard different opinions.
A couple of things at play here. As we've been all locked in and locked in at home, you have seen the trend you've talked about, vacation resort real estate, where people have said, I can work from there, why shouldn't I? And you've seen people, I want to get out of the city. And so any of the suburban areas have seen massive price appreciation away from the core cities where they've seen deep depreciation. Fueling that has also been these low interest rates. Historically, you're never going to see mortgage rates like this around the world. For our Canadian investors, they forget in the U.S. you can take down a 30-year mortgage and not move for 30 years. You don't have to refi it every 5 years, right? Where in Canada, most of the mortgages are adjustable, not adjustable, but have to be refied. So you have seen that be the big driver of, I'd say, pricing. As the 10-year has backed up, that's where mortgage rates are tied to. That will take some of the froth out as that back up in rates. I'd say the next big thing to watch is, I think Judy and I talk about this constantly with our team, about, what is the future of work, right? And what we've come to is the world is going to have a more hybrid flavor to it. We don't like the word flex, we like hybrid, which is you're going to, some folks, some positions, you're going to be in the office 2 or 3 days a week. Some you're going to be in 4 or 5. How do you fit your real estate out for that? But ultimately, when you reopen life, the people who live or have decided they're going to go move to Miami, or maybe not Miami, or
Texas.
they're going to want to come back to the thing that they loved about those core cities. They're going to want to have a diversity of restaurants, culture, etc. So I'd say there will be a tempering of price appreciation in core cities, but they're not dead. I'd say there'd be massive opportunities potentially in office real estate, hotel. There's been a lot of carnage in the office space around the world, and in great cities. So I'd say that's going to be probably one of the next alternative asset classes I see has some distressed opportunity will be real estate. But I don't think the core cities are dead. But I do think the runaway price appreciation for the top 10 cities around the world is probably over for a while. And I'd say the same for the suburban or the / resort real estate. The initial fueling of I can do this forever on the beach is probably a little bit much of a stretch.
Like I like to say all the time in my posts, and I hope my family never listens, COVID has made us stay and spend way more time with our loved ones, which is why we love them less now. So I hope my wife's not here. Where do the esteemed guests, which are you, view the distressed assets over the next 5 years? Will there be a potential survival of the fittest in the private equity groups versus SPACs when it comes to market opportunities?
Yeah, great question. There are pockets of froth, right? The SPAC market is clearly, I look at issuance constantly, right? And you don't mind a lot of issuance when there's a lot of cash that is coming into the market, because that just says there's money to buy what's being issued. Where the musical chairs will stop is when the equity inflows stop and people have to sell other things to buy that speculative thing. You saw a SPAC this morning that bought one of these EV makers overnight and is down 45% today. And so, when every athlete in the world or musician or movie star puts his name on a SPAC, it's sort of, there is a bubble there. So I think that's one. Two, on the valuations, what we saw pre-COVID, if you remember, the IPOs of Uber, Lyft, the failed WeWork IPO, right? It showed us something, that private market valuations were probably ahead of what the public market would ever pay for some of these things. In WeWork, it would be a textbook example we should all go back and look at. and how underwriters actually thought they could take that to market at the time. So I'd say there are pockets of fraud that are going to manifest itself. And what we think is, I think that, play down the middle, I think credit's great. I think, as I said, distressed real estate will be interesting. I think new tech, not the SPAC stuff, but new emerging technologies I think are going to be interesting. This will be the greatest decade of innovation that we've probably seen. When you take this many people and send them home and make them work at home and make them live with their parents, I will tell you, when you take 10 million people and put them at home, there are going to be an awful lot of them that we're tinkering around the garage and thinking about new business models, new ways of doing things, all made possible by the emergence of 5G, right? Which is going to make things even faster than we ever thought. So I'd say emerging technology is going to be a very interesting space. So I would stay away from the classical, late cycle venture stuff that's already been bid up, and stay away from the SPAC world.
Kevin, there is a question there I see, Denny, that speaks to how will our product compete with the ones that are kind of already out there. Northleaf and McKinsey has announced that they're coming out with something. We know CI just announced a transaction, oddly enough, for private equity with Adams, and of course 9 Point's been long in this space with good traction and very good numbers. Our product offering, you will hear from Ryan Dunfield more specifically on March 3rd, and love to have whoever asked that question join us. But Kevin, did you want to maybe canvas some of the high level points that we know we think we are very competitive on? Yeah,
I think the main one for me is the structure. We spent a lot of time on building the structure. We know others were looking at what we were doing about that, and have tried to, and I guess flattery, when people copy you, is the best form of flattery. So I'm okay with that. It's the structure I think is still pretty innovative. I think that the team we've got that is doing this, is seasoned, has done this, has worked through some great credit transactions in the energy space when it got dislocated. So I've got a lot of great comfort in the team and the structure here, and I think we're going to compete very well. So I like our product. Obviously I'm biased, but I like the way we put it together as well.
Through any of your distribution channels, would you look at alternative lending space, such as mortgage investment corporations? Your thoughts?
Yeah, if my CFO was on the phone, he'd be laughing. When every now and then you feel like there's a bubble around you when people start to show you things. And I'd say it was probably 2019. More and more people came out of the woods trying to sell us their mortgage businesses and other things, right? I think there'll be an opportunity there. I'm not sure it's there yet. You saw what happened with some of the folks who packaged illiquid things in a liquid wrapper. That's problematic, right? And so the mortgage industry has wounded some folks. I think there'll be opportunities there. I'd say I'd play it through maybe the real estate side, right? I mean the hard asset side of it, because you have the collateral with it. But yeah, I think it's probably worth looking at now, but it wasn't when people were coming out of the woodwork trying to sell their mortgage business in 19. It felt frothy.
How are you going to address liquidity? Will you be packaging syndicates with true private credit investments? Is there going to be a lockup? Is the focus on the Canadian middle market?
Yeah, we like the Canadian middle market. As I said earlier, we think it's underserved. We think that you can probably pick up a couple hundred basis points of premium for serving that market. And the ability to be a direct lender in that market allows you to create some terms that are probably more favorable to you. I'd say in terms of liquidity, we have thought very innovatively how to create using actual liquid vehicles around the structure. So we're not going to have to sell illiquid things to provide that. And with the window being a 2-year gate, it has ample time for us to figure out how to size up that buffer. But we're actually going to be using liquid product around that.
Some folks are asking about registering to your event on March 3rd. I believe in our automatic email that you'll be receiving tomorrow that we have that information, and if not, send it to us, and everybody who are here will get information about how to register as well. So that's important. I believe I received that information. If not, we'll double check. But you're all going to get the recording of this session and all the information on how to reach the firm directly. You guys, AGF has a big workforce. to what do you attribute the success of your culture?
Great leadership in Kevin. I'll start there. But I won't underestimate or understate what I believe is a key component, which is we are a family business. It started as a family business. We continue to grow and treat our employees very much. Families, maybe a bit of a stretch, especially if you've been hanging out with them too long in COVID there, Denny. But, I think the reality is our team demonstrated that they came together so well during COVID, and that's because we trust each other, and there's just a real sense of culture that does permeate and emanates from the original formation of the company, which really, I believe, is family oriented. And I'm really proud of the culture, frankly, because the team really does perform incredibly well. We really actually like each other, which is nice to say. I don't know.
I would add to that. I'd say, Danny, as much as COVID has taught us all something, there's something when we get through this, we'll all look back at and reflect on. Everybody on this call will have something about this. There will be good that comes out of this, right? For me and Judy at the firm and our senior folks, I think from day one when we started worrying about this, and the fact that we had offices around the world gave us a lens into this early. We have a workforce that's very diverse, which we're proud of. And we saw some things coming out of Asia in January that kind of tipped us off that this was not going to be what the rest of the world. And we prioritized two things, Denny, at the time, which I look back on, which is we have to take care of our workforce, right? We have to take care of our workforce. We have to keep them safe so that they and their families are safe. And then we saw what happened with the carnage in March, right? People were worried about their health, but their wealth got destroyed as well. And the fear that we saw, right? We had to get people through. In the second part to take care of our workforce, we committed to each other. We weren't going to, we didn't have to lay people off. We didn't have to do the things that others did. We had taken some, probably the last 4 or 5 years, the things we needed to do, because frankly, we thought we were kind of at the end of an economic cycle. So when we hit this, we were prepared. And so we were able to take care of people throughout it. And I think when we look back at that, that has made our culture very strong. And at the same time, the second message we had was take care of our clients. You can't believe the amount of things we did, messaging, reach outs, content. Our chief political strategist, Greg Valliere, if anybody gets his daily stuff from us, was invaluable to keeping people aligned with what the firm was doing, because everyone was trying to figure out what was going on. So I think, take care of your people, take care of your clients, take care of your employees, and it serves you well.
Maybe last, can foreign investors invest with you as well? And maybe just your thoughts about the forecast for the next decade.
Yeah, so we have, as I said, on many of our products, we handle investors are all around the world. EMEA is one of our larger distribution points. The US, we have a fair presence. This particular product, I believe, is going to be US and Canadian investors. But obviously, at size, people can create a special one-off product. So I would defer that to the investor day to focus on that. In terms of the outlook, I think that, we are going to be in a reflating world. I think that if you look at everybody, I always get worried everyone's lined up on one side of the ship, right? Everyone loved big tech, all the FANG names that got us to them. They were great companies, right? But their valuations got stretched. Don't look at the headline indexes, especially those which have big weights, big names that make up 25, 26, 27% of the weight. They're going to look stalled. When you look through them, the underlying names are doing pretty well. We could see a market that actually does pretty well under the surface. So look at the equal weighted indexes, not the headline indexes. Two, you're going to see a couple of corrections in here as we fight our way through to the day when the world is fully vaccinated. You saw this morning in the UK, Boris Johnson said that he's proclaimed that June 21st, every social restriction will expire. He may be optimistic, but you're going to see different economies pace differently between how they get people vaccinated. The UK has got 28% of their population vaccinated. The Israelis have 85%. And now that we know that once vaccinated, you can't transmit the virus, you're going to be able to open up borders quicker for those countries that do have that level of vaccination. So that's the second part of it, is pay attention to the pace of vaccinations in terms of where the economies are going to be. You look at the US is probably going to pace to GDP growth that could exceed 5 to 6% this year in 2021. You look at Canada, we're probably in a recession in Q4 of last year and Q1 of this year because of the lockdowns. So very different economies are going to have very different outcomes from markets. Broadly speaking, we think equity markets will grind their way higher through these couple of corrections this year, be at a higher place. And then you really have to sit back and say, what does 2022 look like? Right? You're going to be on the precipice of central banks starting to say, we got through it. Rates need to go higher. And you're probably going to hear a lot of governments around the world talk about taxes. Certainly in the US, you're going to hear it. Just the whiff and hint of taxes, higher capital gains taxes, higher corporate taxes will be a headwind that markets will have to fight through. So I think 2021 ends up as a good year for equities, but not a 20, 30% year, high singles, low teens. We think fixed income, I think, be careful. You could see the 10-year back right through 150 pretty quickly. And at that level, it's the pace at which it gets there, not the absolute level that you worry about. And so, fixed income could see its way higher. I'd be very careful being long duration assets in fixed income right now.
How long ago have you joined the firm again?
I've been here 6 years, and I've been CIO for 20-something years around the world, and 6 years here and 2 in the CEO seat.
Wow, 6 years. So you can already go and use the path without getting lost, right?
It took me all until last year, and then we shut things down. And actually, when we shut down, there was nobody in the path, so I got to explore the path on my own as my exercise every day with Judy, because we were the last ones to leave. But yeah, it's a great city. It's a little gray and dark in January and February when you're in lockdown, but it's a great city, great company too.
Absolutely. We did our first event in Toronto 2 years ago. Easy Shark opened at the Four Seasons, was amazing. And we have great friends in the Canadian market over the last couple of years. If you've seen some of my guests, included Desmarais, De Gaspé, Saputo, and others. So yes, I would like to thank you. Is there anything else you'd like to add at this point?
No, I think fantastic. Thank you very much for taking the time, Ben.
Sure.
Yeah, thanks, Danny. Thank you.
Thank you. And I'll just tell everybody what's coming up next on Thursday. We got a very interesting conversation with an interesting guy who is a genius from Wall Street. He was the head of AI, I believe, in JP Morgan. He was a doctor that decided after 5 years to stop, his career there. By the way, if he had a Jewish mother, that would have been
Not allowed.
Yeah. And he left to the financial markets, heading the AI there. And now he's got a fund that does something very interesting. On one hand, they invest in top AI firms, and on the other, in old economy firms like restaurants, construction. They don't really yet use those new AI and technology that they need definitely now during COVID. Invest in both. He also puts them together to make business together. And it's a very interesting discussion. And then later on, we have a blockchain family office event. It's trying to figure out what's going on there. It's the only sector I know when one investment bank will tell you it's worth $150,000 by the end of the year. And at the same time, another strategist tells you it is worth $0. And then April 22nd, we'll be doing our in-person conference at the rooftop of the World Trade Center.
Oh.
Yeah, it's at the rooftop with Larry Silverstein, one of the most iconic names in the United States when it comes to real estate, that came here with nothing, ended up owning the World Trade Center 5 days or so before 9/11. Unbelievable. And what they've done since. And then in June, we're supposed to do, unless COVID will surprise us even more, our first event at the UAE. So get ready for all of that. Thank you so much. I'm looking forward to meeting you, Kevin and Judy, in person with no masks in Toronto and in New York. Thank you so much for joining me, everybody. We're going to send information as we always do. The system does it automatically in 24 hours. So when it's 11 EST, check your email, okay? Thank you, everybody. We'll see you soon. Stay safe.
Thank you. Bye-bye.
Thank you. Bye now.